Good evening and welcome to this year's Dow lecture hosted by the National Institute of Economic and Social Research. My name is Adrian Papps. I'm Deputy Director for Social and Political Economy. It's my great pleasure to welcome you to tonight's event, one of our flagship events here at NIESR. Before we start, may I take this opportunity to introduce my colleague Handa Küçük, who's Deputy Director for Macroeconomics, and who together with a team have just published our new two forecasts. In the global forecast, there is a very interesting topical feature on US monetary policy, which very much relates to tonight's lecture and to the work of our distinguished speaker, Jim Bullard. But I'd now like to introduce the chair for tonight's proceedings, Sir Paul Tucker. Paul is currently a research fellow at the Harvard Kennedy School, the chairman of the Systemic Risk Council, and the president of the National Institute of Economic and Social Research. It's a great honor that he's chairing tonight's meeting, and I'd like to now pass the floor to Paul. Thank you very much, Paul.
Thanks very much, Adrian. Hello, everybody. Apologies for my attire. It's pretty cold where I am, and the central heating is temporarily broken. But I'm looking forward to this evening very much. Let me first of all say something about Christopher Dow, in whose name this lecture is given. After a period at the Treasury, Christopher Dow was Deputy Director of the National Institute before moving on famously to be Chief Economist at the OECD, and then moving, I think, for the final job in his the main part of his career to being Chief Economist at the Bank of England, where in fact he was as Chief Economist when I joined there many moons ago. And because he was at the Bank of England during the late 1970s and early 1980s, he was very much part of that generation, and I think of Douglas Wass at the Treasury as well, who were having to cope with the switch from a macroeconomic stabilization regime that had depended mainly on fiscal policy with a non-independent monetary policy in support to relying on monetary policy, initially non-independently. And this has been in my mind this week because the balance of fiscal policy and monetary policy is, as everybody watching knows, very much a live issue again. In fact, this Friday, Larry Summers and Paul Krugman will be having a public debate about the latest fiscal stimulus in the States and the possible monetary effects on Marcus Brunnemeyer's webinar series at Princeton. So I think Christopher Dow would have been pleased that this debate was back, but obviously he'd be very sad about the circumstances of a pronounced, well, more than recession, kind of seizure in the economy that has made it so topical again. We're very lucky that Jim Bullard, the president of the St. Louis Regional Fed, is giving the Dow lecture this evening. Jim has been in central banking for a long time. We were just saying to each other that we think we met sometime in the mid-1990s. The last time we saw each other was at a conference that Jim hosted in St. Louis to mark an anniversary of the famous Diamond Dybvig paper, Phil Dybvig being based in St. Louis. Jim is a seasoned policymaker, an active participant in the public debate about monetary policy and about financial stability policy. And during an extraordinary period, a quite extraordinary period, to have any instruments of policy at all, let alone know quite what to do with them. And so Jim, over to you. Thank you very much for joining us this evening. It would have been even better if we were all in London together, but thankfully, this terrible plague has afflicted our generation with technology that can link us and give us your wisdom. Over to you, Jim. Thank you.
Well, thanks very much, Paul, and thanks to the Institute for inviting me today. And I very much wish I could be back in London to meet you all personally and see all my friends in London. I really enjoy my visits there, but right now we have to do it virtually. So that's what we'll do. I thought what I'd do with this lecture is talk about my work with Ricardo Di Cecchio, who's also here at the St. Louis Fed, on classic policy benchmarks for economies with substantial inequality. The key words here are substantial inequality. So this will be a macroeconomic world in which we get the sorts of inequality that we see out there in the real world. And then we're going to ask ourselves, well, what can policy do? What should policy be doing to conduct the best possible policy in that kind of a world? So let's go to the next slide here. And the next slide. So I'm going to, this deck has some academic aspects to it, but it also has a lot of pictures. I'm going to focus mostly on the pictures. This is about economic theory, but in the theory it's called heterogeneous agent. That just means people are different inside the model. A lot of macroeconomics historically has not had this. They've had just the representative agent or some simple version of the representative agent, but here we're going to have people being very different. And in fact, we're going to have realistic degrees of inequality, which means we're going to approach the observed Gini coefficients. So the Gini coefficient is 0 if things are perfectly equal, and it's 1 if things are perfectly unequal, and something in between. The Gini coefficients, especially in the United States, are considered extremely high. We're going to have that in this model. And then we're going to ask ourselves, well, what's the role of monetary policy and other policies in this world? And the answer is going to be that the role of monetary policy is unchanged. So just to put some context around this, Barack Obama made a comment at one point to the effect that income inequality was the most pressing issue of our time. And I would say, generally speaking, since that comment, central banks have been pressed to say, well, can't you conduct monetary policy in a way that's going to do something about the income inequality that we observe? This is going to be a story here where it really falls to other policymakers, as I'll describe, to get the best outcome for the economy. And that monetary policy doesn't really change whether you have a lot of inequality or somewhat subdued inequality. So let's go to the next slide. So what this is going to be in a paper is there'll be actual mathematical economy that we'll construct. There will be shocks in this economy, quite a few shocks actually, unlike many models, but certainly total factor of productivity will be growing at a random rate over time. Labor supply will be changing over time. Aggregate demand be changing over time. So the economy is hit by these various shocks. Then in addition to that, and consistent with the existing literature, there's also going to be risk at the household level. So as individuals in the economy, we also get our own shocks, the things that happen in our own personal lives. Those will also be in this model. We're going to have a simple and symmetric structure in order to keep track of everything and keep track of the math. But we are going to get income, financial wealth, and consumption equality that's on the same scale as what we see in the data. And then what's going to happen is that we're going to have the sort of the 4 horsemen of this talk, the 4 policymakers: a monetary policymaker, a fiscal policymaker, a labor market policymaker, and most controversially, an education policymaker. And these 4 together can act in concert. And there'll actually be a theorem here. They can actually act in concert to get the first best allocation of resources. So let's go to the next slide. So what these various policymakers do is something that would be considered very classic, and hence the title of this talk. The monetary policymaker is going to be reacting to shocks all the time in order to achieve the so-called Wickselian natural real rate of interest for the economy, just as they would in a new Keynesian economy popularized by Michael Woodford and Jordi Galli and others. So the monetary authority is doing the same thing that they would do even in those economies that didn't have this kind of heterogeneity. The fiscal authority can raise revenue in this world and pay for government operations. The labor market authority is going to have to run a good unemployment insurance program, so that'll be their role. And finally, the education authority, the most controversial of the ones in this, of the four horsemen here, is going to minimize the variance of beginning of life human capital endowments. I'll talk about that extensively in this talk, because that's going to be one of the key sources of income and wealth inequality in this world. So my argument is that the main result is that these classic policy prescriptions can actually achieve the first best allocation of resources, even when you have substantial inequality as part of the model. And what I want to do is lay down this benchmark so that we all have a shared understanding. And then from here, you could take this model, you could twist it in various ways, add your favorite features to it, and then see how these types of policies would change in order to get you back to the best allocation of resources. But in this benchmark economy, these four policies will get you all the way there. Let's go to the next slide. So there are some surprising findings here, I think, relative to what's being said and what's out there in the literature. Perhaps the most surprising is that the classic policies are broadly similar to actual policies in place in many economies. So in some broad level terms, we're already doing the things that we would have to do to at least to try to move in the direction of the best allocation of resources. One thing I like about this is that it gives some rationale about the monetary authority. Why is the monetary authority meeting all the time and always trying to assess the state of the economy? That's because it's the monetary authority's job to react to these shocks that are coming in and to get the real rate of interest correct in the economy. So you're always seeing the monetary guys reacting to current developments. The fiscal side, they can set taxes for the medium run or the long run, actually forever in this model, but they don't have to revisit tax policy very often. They can raise the amount of revenue they need to run the government. You don't need age-dependent taxation here, which is something that's talked about in the literature. So if you had another surprising finding, and probably this is if you want one takeaway from this, it's the very best policy combination would drive the consumption Gini coefficient all the way towards zero. But the income Gini would not go to zero, even with all these really great policies in place. And the financial wealth Gini would not go to zero either. They would remain substantially positive. Why is that? That's because this is a life cycle economy, and you're going to have a certain amount of income inequality because of the nature of the life cycle, and a certain amount of financial wealth inequality because of the nature of the life cycle. People are saving for retirement. Other people are borrowing to pull consumption forward in the life cycle. So those Gini coefficients, even under the fully optimal policy, would not go to zero. In fact, they would stay quite high. So a lot of the observed income inequality that we see out there in the data is really just coming from the life cycle. I think that's something that's important to communicate and think about as we go forward. Not all of it is due to that, and as we'll see, there's another source. This is all pencil and paper solution, so you don't have to compute something really difficult here. Let's go to the next slide. Here are a bunch of papers that I've been reacting to and talking about, but in the interest of time, I'm going to skip this slide. So let's go to the next one and the next one. So this is a what's called a general equilibrium life cycle economy. It means that people come in and we start keeping track of them at age 20, and then they live for, they make decisions on a quarterly basis. So that's 241 quarters, and then they exit the economy at age 80. I think you should get away from the notion of being born and dying. It's just that we're keeping track of people during this window on the gut instinct that if we figure out what these heads of household are doing during this period, then we'll have a pretty good take on what's going on in the economy. There, within each cohort, there's actually a continuum of households. So we've got lots of households here, and they're going to have a certain simple structure that I put on this to make this all solvable by pencil and paper. And some of these features are listed here under the so-called symmetry assumptions. Let's go to the next slide. So the preferences are, this is, the households want to do the very best they can, and they want to consume, but they also want to take leisure. And so that's what's in the preferences. There is a demand shock here. And so let's go to the next slide. And then on the production side, it's just linear production. So you produce some output using labor as the input and subject to these shocks that occur. By the way, the end shock here would be, you'd have to interpret that as immigration. So you'd have a wave of people coming into your economy or leaving your economy, and then that would change the amount of production that you can do. Let's go to the next slide. Let me just spend a minute on this because this is critical for how this works. When you come into this economy at age 20, I'm going to hand you a productivity profile. So what is this? This is a bunch of productivity units at each point in your life cycle, all 241 periods every quarter. And this is the amount of productivity you'll be able to sell on an open labor market. And you'll get a wage per efficiency unit that's a competitive wage that you get paid. So it's going to help you a lot to have more of these efficiency units. And if you don't have very many efficiency units, you're not going to be doing as well. And so this is critical to as we think about what's going on in this paper. Now, there's a baseline profile, which is sort of what everybody would get. This baseline profile has the feature that it's low in the beginning of life, it peaks exactly at the middle of life, and then it goes down again as you get toward the end of the life cycle. And this perfectly symmetric structure helps us in this paper guess what the solution is going to be. But it also reflects reality, the idea that you would have peak earning years in the middle of the life cycle, and that's a lot of what's going to drive what's going on in this paper. Now, in addition to this, just to make things a little more complicated for you, we're going to, not only is there this baseline profile, but you're going to get a random draw, which on this slide is xi here, from a log normal distribution, and then that will multiply this, this baseline profile either up or down. Now, if you know a log normal distribution, it goes from 0 out to infinity. So your particular profile that you get when you enter the model could be really close to 0, or it could be extremely high. This means we'll have arbitrarily rich and arbitrarily poor households in this model. Elon Musk is somewhere in this model, and the very poorest of the poor households also in this model. So got the whole gamut here covered by some clever math. Let's go to the next slide. Oh, the bottom there said, I'm going to show you pictures. The pictures don't have that log normal distribution. They have a uniform distribution. So you would get something between a low of an A and a high of a B. So I'll show you the pictures, but you'll get the hang of it here in just a second. Okay, why are we doing all this and why am I talking about this? Well, it's really this Huggett-Ventura Yaron paper and a wide literature around that, which says that if we're trying to project labor earnings for various people, and we have a vector of characteristics on those people at age 23 in the Huggett-Ventura and Yaron paper, you can do a really good job of predicting how much labor income various people will get. And so that suggests that everything's pretty much determined by the time you get to your early 20s. Why is that? That's because you had some amount of education, including formal education, but also including what you've learned from your parents and your environment. And so you're bringing a set of skills to the world in your early 20s, and that pretty much is dictating how your life's going to evolve, at least from a material well-being point of view. So this is what we've got in our model, an extreme version of this, where you get handed this this productivity profile for your whole life, and you've got to live with it and do the best you can at that point. So let's go to the next slide. So here's the baseline profile that I've been talking about. This is normalized so that the average value of the life cycle is 1. And to get the hang of these pictures here, 0 is kind of age 20, and 240 quarters later is age 80. And this is where we're keeping track of people. And then you can see there's a hump here. It actually peaks exactly in the middle, period 120 of the life cycle. And that hump there is about 50%. So you're about 50% more productive in the middle of life than you would be at the beginning of or end of life. It's not that you're not productive, but you're more productive in the middle, and that's going to affect how much you want to work at different stages of the life cycle. So let's go to the next slide. So this is now we take that blue line and we multiply it by a random factor, which would be log normal, but here we've used a uniform. So now you've got some people actually got the higher version of this. They're at the very top of this blue blob here. Other people got the worst version of this. They're at the low end of this blue blob. It looks like it's flat there at the bottom, but that actually is exactly the same profile, which is scaled at the same level. So the person at the bottom there is also 50% more productive in the middle of life than at the beginning or the end, as is the person at the top, Elon Musk up there, also 50% more productive than he is at the beginning or the end. So that has important implications for what's going to happen here, because these people are all going to want to work a lot more in the middle of life than they are at the beginning or the end. So even that top guy there, who's quite productive, even when he's 20 years old, not going to work that much then, because he's going to be even more productive when he's 50 years old. All right, let's go to the next slide. So you can sell your units on a labor market, but there's more shocks. This isn't the only thing that's going on. You might show up for work one day and all of a sudden your job isn't there. So you're unemployed for that day. You can't earn any income on that day. So we're going to have to do something about that as well. I've made it really simple here where this is IID. You could also think of this as health shocks. You're sick one day, you can't work that day, you don't get any income that day. So you're going to have some kind of insurance if we're going to get to the optimal allocation of resources here. And that's what we're going to end up doing. So there's this idiosyncratic risk that you face as well. Let's go to the next slide. Now, the beauty of this structure, and the reason I think it's the future of macroeconomics, is that you've got a large private credit market that naturally occurs in this kind of model. The people that are relatively young they're going to be earning more in the middle of life. They would like to pull consumption toward the beginning of life. So they're natural borrowers in this setting. And the people in the middle of life are earning a lot of labor income, but they would like to save some of that for retirement. So they're natural creditors in this environment. So you have a large private sector credit market, just like the one we observe in the data, and that's surely informed by what we actually observe. This is a private credit market. So far I haven't talked about government at all. So these are, really privately issued household debt. I like to think of the asset in this model as mortgage-backed securities. So with mortgage-backed securities, you're buying a house because you want to move housing services more toward the beginning of the life cycle, and the middle-age agents want to lend you the money to do that because they want to save for retirement and move some of their income to be able to consume toward the end of the life cycle. And so a mortgage-backed security is a good way to think about that. That's a pretty big market in the US all by itself, about 16.4 trillion as of the third quarter of 2020. So it's about 3/4 of a GDP in the US. Let's go to the next slide. This credit market does not work perfectly, which is going to create a role for monetary policy. There's non-state contingent nominal contracting. So what's happening is that households are borrowing, relatively young households are borrowing, but they just borrow a certain amount of money and at a stated nominal interest rate, which is really not what they should be doing from an optimal contracting perspective. But this is the friction in the model, and this is what we observe in the data. There's two aspects to it. It means that it's the allocation of resources would be distorted by it, but it also means that because it's in nominal terms, the monetary authority can fix this friction and restore the Wexelian natural real rate of interest. And that's exactly what's going to happen with the monetary policymaker in this model. Let's go to the next slide. So there are a lot of additional assumptions, which I'm going to skip here. Let's go to the next slide. And the next slide. So let's talk about these four horsemen of policy here. You got a monetary authority. They get to observe these aggregate shocks and set the price level. You got a fiscal authority that can set some taxes, a labor market authority that can observe what's going on at a household specific level, so they know who's received this idiosyncratic shock and who can't work on a particular day. Then you've got this controversial education authority, which can control the initial dispersion of life cycle productivity endowments. Let's go to the next slide. So the proposed policymaker mix is that the monetary authority does nominal GDP targeting, which is another way of just saying that they make it so that the real rate of interest is the correct real rate of interest for this economy. The fiscal authority can actually tax without labor income without distorting anything in this economy. Labor market authority can also raise a tax on all workers and then pay out unemployment insurance to those that get hit by the idiosyncratic shock. And the education authority, what can this guy do? They can minimize the dispersion of life cycle productivity profiles by setting the standard deviation of that to a minimum value, possibly zero. So that would be that you have a great education system, which means that everyone coming into the model at age 20 would have the same set of skills and the same life cycle productivity profile, or at least a minimized variance of that. Let's go to the next slide. There's a theorem that says that if all these things happen, this is actually the best allocation of resources. Let's go to the next slide. So let's show some pictures and then go from there. Let's go to the next slide. And the next slide. This is meant to convince you that monetary policy doesn't look strange. When a recession hits, nominal interest rates fall. So very standard in that sense. Let's go to the next slide. This is some math with the leisure choices telling you why the taxes aren't distortionary. Let's go to the next slide. Okay, here's hours worked over the life cycle. Again, you're entering the economy at 0 here and you're exiting at 240. These are quarters. And the blue line is how much labor you're going to supply. And this is true for all households, both the rich households and the poor households all supply the same amount of labor, that blue line there. So what does this say? It says that they work very little at the beginning and the end, and they work a lot in the middle. And the average is the dotted red line there. It's not just that you're more productive in the middle of life, your peak earning years, it's that you also choose to work a lot of hours there. And that's what creates the income inequality. So let's go to the next slide. This is about education policy. So the dispersion at the beginning of the life cycle, I'm not sure how the education authority can do that. Some countries do a good job of this, But you really want very equal education, very equal skills adoption before people enter, before people get to age 20, because by the time they get to their early 20s, you can predict their whole life cycle earnings. So you really want them to have the right set of skills when they come into the model. That's what the education policy is talking about. Let's go to the next slide. Next. Next slide. So this is the labor income slide here. The blue line would be for the guy that has the baseline productivity profile, and the blob would be for everyone else. So they work very little at the beginning or the end of the life cycle. So they earn very little at the beginning of the end of the life cycle. We're going to calculate the Gini coefficient of this blue blob here, and it's going to be very close to what it is in the data, but it's just because there's peak earning years in this framework. Let's go to the next slide. And then how much will they consume? Well, they're going to use the credit market to try to smooth out consumption over the life cycle. That's what this red box is doing. And for the guy with the blue line of labor earnings, they're going to have the consumption on the red line there. This is a little bit deceptive because this is a point in time picture. This is stochastic, so this would go up over time because the economy is growing. But basically, you get the idea that they're going to use the credit market to smooth consumption. Let's go to the next slide. And here's what consumption would do over time. And then these various colorful lines here show what you would see if you observe particular individuals in this economy. Consumption would be, aggregate consumption be going up over time, and the individuals would have these various experiences. Let's go to the next slide. This is my favorite slide. This is net asset holding in this economy. The guys on the left side of this has to integrate to zero. The blue line would be the guy with the baseline profile. The others would have other profiles. So the very rich guys like Elon Musk also borrow a lot. That's the very lowest part of the blue blob there. And then on the right-hand side of this picture, you have positive asset holdings, which peaks right around age 65, period 180 in this model, because of course they want to carry some of the ability to consume into the later years of the life cycle. So this is a consequence of the natural credit market in this model. We're going to calculate the Gini coefficient of the right-hand side of this picture, and it's going to be close to the data. Let's go to the next slide. We're going to skip these slides here in the interest of time. These are other ways to look at income. Next slide. Because there is capital income in this model, because some people are earning interest on their savings. Let's go to the next slide. Next slide. Marginal propensities to consume, which have been quite the topic in macroeconomics. This paper has various marginal propensities to consume, also entering the policy debate a lot, including the current fiscal policy debate. Are you giving money to those who are likely to consume? Well, this model has poor hand-to-mouth consumers. That would be where the blue line crosses the dotted line here. And wealthy hand-to-mouth consumers, that would be, again, where the blue line crosses again. So you do have variable marginal propensities to consume in this paper. Let's go to the next slide. And let's talk about inequality. Next slide. Here's the US data across the top there. The wealth Gini is about an 80. Income Gini is about a 51, and the consumption Gini is a 32. These are pre-tax. This is often done on a pre-tax basis. Not clear you should do it on a pre-tax basis because there are policies in place to mitigate inequality. But on a pre-tax basis, that's what you would get in the model. If you had the log normal distribution of productivity profiles, the bottom line there, you would get the income and consumption Ginis exactly right, and you'd be a little bit short on the wealth Gini, and I'm going to show you a picture of that. Let's go to the next slide. Here's the picture. So let me just, this is almost my last slide here. So let me just take a minute and talk about this, and then I think I'm pretty close to concluding. So this slide says, looks busy, but you're going to love this. So the horizontal axis is dispersion parameters. So that means how much dispersion is there around these productivity profiles? Is there just one productivity profile? That would be a sigma of 0. So that's over on the left axis. Or do we have lots of dispersion among the productivity profiles at the beginning of the life cycle? That would be over on the right-hand side of this picture. So the green line is the consumption Gini as a function of this sigma. The blue line is the labor income Gini as a function of this sigma. And the red line is the financial wealth Gini as a function of this sigma. So as you go to the right in this picture, you're getting more and more and more inequality. And if you go high enough, you will actually get your Gini coefficients to go all the way to 1, which would be a perfectly unequal society. Elon Musk would have taken over and have all the wealth and all of the labor income. So if you go to the right in this picture, you get really high Ginis. We've calibrated at the black vertical line here, which gives us three Gini coefficients, which are pretty close to the data. But you could equally well use the yellow line, the yellow vertical line here, and then you would get the financial wealth Gini right at the cost of getting the income Gini a little bit too high and the consumption Gini a little bit too high. Now, what's interesting about this picture is that the very best equilibrium would be that the education guy is able to make all the skill levels of everybody that's coming into the economy at age 20 exactly the same, so that they all get handed exactly the same life cycle productivity profile. That would be the vertical axis at 0, sigma equals 0. So that's the social optimum. It's listed as social optimum on this in this picture here. That's probably not feasible, but as a conceptual exercise, it's kind of interesting. So what would you get there? You would get the consumption Gini would be 0, so that you'd have perfect equality of consumption. But the income Gini would not be 0. It'd still be a 0.44, and the financial wealth Gini would not go to 0. It'd still be a 0.65, which would be considered, and in today's discussion, those would still be considered big numbers. But a lot of that's just coming from the life cycle. So I think that's an important contributor to today's debate, even though this is a theoretical exercise, but it clarifies things in our minds about what we think is going on and what is it that we want to fix about the income and wealth distribution. Let's go to the next slide. All right, I'm going to conclude. So what this argument has said is that you could have a classic combination of policies and get a first best allocation of resources, even in an environment where you had substantial inequality in income, wealth, and consumption. The monetary policymaker does what ordinary monetary policymakers do, which is keeps track of the incoming aggregate shocks and tries to get the real interest rate to be the correct real interest rate for that particular vector of shocks. That enables the fiscal authority to lay down some taxes that don't have to be changed very often and fund the government. The labor market authority has to run some kind of unemployment insurance program, and you could also put health insurance program in there because of health shocks. And finally, you've got this education policy, which is looming over all of this, which is that you really want people to be coming in with great skills as they enter the workforce at the beginning of the life cycle, because that's going to determine how well they can do during their whole life. So I think that this might be a useful way to think about things. And then from here, you could distort, twist, change assumptions, and then you could talk about how that would change policies. But this gives you a kind of benchmark, and it's not that far from what actual policy is like, both in the US and the UK. So thanks for the chance to regale you about this, and I'm looking forward to questions. Thank you, Paul.
Oh, Jim, this was really great. Absolutely fascinating. I hope the audience are going to bombard me with questions that I can pass on, but I'm going to indulge myself and ask one initially, which is this. So as you were presenting it, I thought, so what we've got here is a kind of a classical economy with an efficient social democratic state, to use the kind of European type language. And as you said when you were concluding, you can kind of have health problems as well, and you just plug into the model some kind of health insurance and provision system. And in a world where what I'm going to call the social democratic state functions efficiently, it turns out that the monetary policymaker can stick to doing what probably intuitively, or certainly historically, over the past quarter of a century or so, we've thought the monetary policymaker does do and should do. And as you said, you're providing a benchmark, and I must say it's a very interesting one. And the question I've got, and you may not have worked this through yet, so I'm just asking you to speculate. If we take a world where some part or parts of the social democratic state, the unemployment bit, the health bit, the education bit is materially inefficient, what then for the monetary policymaker? And I'm asking this not only because I think the model invites that kind of question, but also because I think that over your and my adult lives, and that of many of the people watching, something extraordinary has happened. Central bank independence is kind of predicated on a view, I think correct, that elected policymakers will be tempted to do some things that we, society, or the social planner, actually doesn't want them to do. And so we take away the monetary instrument so that they won't do certain things, and somebody else politely gets on and does it without so many abuses, mistakes rather than abuses. But there's another problem, which I think the central banking world has been confronting over the past, well, nearly decade now, which is if other parts of the government machine, here the social democratic state, doesn't do what it should do, then are we left with the central bank somehow having to substitute for the social democratic state? And one could plug in here climate change, which would be topical on both sides of the Atlantic now. But this is your model, your benchmark model presents a kind of quite a pristine central banker or monetary policy maker who can stick to what you and I think of as monetary policy. But if the social democratic state, as I'm terming it, doesn't do what they should do, what can or should, different questions, should the monetary policy maker then do?
Yeah, I mean, these are great questions, and that's exactly that type of debate I'd like to set up here. So a simple thing would be the health shock or the unemployment shock isn't fully insured or isn't insured in the proper way. And then, so what would you have in that world? You'd have workers that on the day they get hit by their health shock or their unemployment shock, they're not producing and they're not being insured quite properly. Then that's going to distort probably what the monetary policy guy should do, and they would take that into account, and that the interest rate would no longer be the pristine Wixellian, natural rate of interest. It would be some distorted version of that, and I think that's where you get into trouble. But what the monetary policymaker should probably do is say, "Hey, government, you got to get that insurance to be exactly right, so that we don't mess up credit markets." In order to fix what is really a problem there's an insurance problem that needs to be fixed. So I think it is proper for these four horsemen to be arguing with each other about where the proper roles are. Otherwise, you're gonna if you decide, okay, we're gonna try to use monetary policy to fix this, then you're gonna get a distorted credit market at the expense of trying to offer some additional insurance for those that have been hit by idiosyncratic shocks. But these are great issues, I think, that hopefully this sets up that you could start to talk about. Another version of this would be the education policy. And maybe the education is just not very good, and so you're getting wide dispersion of skill sets coming into the economy, and that's for sure going to lead to more income inequality than you would otherwise have. I'm not sure the monetary policymaker then can do very much about that, because distorting the credit market on account of that is not going to really help anybody, or everyone has a life cycle savings problem and a life cycle allocation problem to solve, and they want to use credit markets as best they can to solve that problem. So it's not clear to me if the education process isn't working correctly, that there's anything the monetary policy can do to make up for that. But these are the kinds of things I would like to set up here with this benchmark economy.
Thank you very much, Jim. As I was going through the questions, I saw that John Vickers had also asked my question, which I should recognize. And I'm now pleased with myself for having thought of John's question without seeing he had. I'll pass on two questions at once, if I may. Kanya asks, what difference do you think it would make if the education policymaker, who kind of, as it were, chooses the distribution at age 20, what if there's a cost to doing that? How would that flow through? And Arnab asks, is it right that here inequality isn't in the utility function, isn't in the welfare function? And how would it change things if inequality were directly in the utility function rather than being kind of part of the technology of the model, structure of the model?
Okay, I want to take that question because that's very important. If you noticed in the middle of the talk, I rushed over it, but there was a theorem in the middle, and the theorem works like this. Let's suppose the education authority could make it so that everybody got exactly the same profile when they were at age 20. So there's just one productivity profile. You still got life cycle from there. You still got income inequality from there. And you still got financial wealth inequality, but consumption would be exactly equal. So I think the way to think about how the theorem works is, and what the social planner would do is discount forward and backward in time at the real rate of interest, which is also the output growth rate in this economy. So in some sense, everybody that lived at any point in time going into the infinite future, the infinite past, would have exactly the same life, and they get their lifetime utility would be exactly the same. So that's the sense in which you truly are getting the social optimum in that case. You do have to discount backward and forward. The people that lived earlier have less resources because the economy was not grow or has been growing over time. So you have more resources. Better to be born later. But if you correct for that, you get an exact theorem on this. So would you want to squeeze income inequality down further than that? No, you would not want to. You would want to allow that to be there because you're allowing the fact that there's peak earning years in the middle of the life cycle. That's what's driving the income inequality. You don't want to squeeze that down. You want people to be able to choose to work more in the middle of the life cycle, and then they're going to earn more, and they're going to use credit markets to smooth consumption over the life cycle. You want all that to occur. So the ideal Gini coefficient for income would be the 0.44. According to this calibration that I got late in the presentation. So it is a full social optimum is the point of that rant there. The other question was about well, what if it's costly to run the education policy, which surely it is. There actually is scope for non-distortionary taxation here. So you would run that, you would tax at a rate that would be you'd have to figure out, I guess, what the how much education, how much you want to invest in education to make it so that everyone had exactly the same skills, or as low a variance as you could get when they come into the model at age 20. I think the way to think about that initial distribution, and this is all very controversial, but part of it is a talent distribution that would be a natural talent distribution in the economy. And then part of it is that there's also education policy, which is supposed to be giving people the basic skills that they have, but you'd still have some people that are going to do very well no matter how you cut it, and other people are probably not going to do as well no matter how you cut it. So there'd be a minimal amount. So you'd like that to only reflect the natural talent distribution and not to be exacerbated by the fact that some people aren't getting very good education, and that therefore they're paying their whole life, really, lifetime earnings are affected by that.
Thank you, Jim. Two more questions, if I may. The first from Luis Corrado asks, the Gini coefficients seem pretty high if it's being driven by life cycle stuff alone. What are your thoughts about that? And Handa from the National Institute says, and I guess that this kind of thought will be on many people's minds, so that the kind of monetary policy instrument here is a nice monetary policy instrument that is kind of Wickselian, but actually because of the zero bound problem, central banks have been using quantitative easing, which kind of, some people think, and maybe does, drives up wealth inequalities. And this, perhaps if I develop Handa's question, I think is, and so what about that? And if I could then reflect that into almost the converse of my own initial question. So is the zero lower bound and relying on, let's assume that QE does increase wealth inequalities or something, does that mean that when the monetary policy maker hits the lower bound, what I call the social democratic state policymakers have to be more active than otherwise, in particular, whether it's the health insurance or unemployment insurance or some kind of insurance that kind of undoes some of the Gini effects, as it were, of a constrained monetary policy.
So the first question was whether the Gini coefficients seem high for what you should be able to get out of a life cycle model. I think that's a good question. And as I said, this is a simple and stylized version. And we've sort of taken the liberty of just assigning this productivity profile to the households. And this productivity profile, what is it? Well, you're 50% more productive in the middle of life than at the beginning or the end. That is actually not too different from other calibrations that have been used in the life cycle literature, like Auerbach and Kolikoff and subsequent literature. So it's not like we're saying you're 10 times more productive in the middle of life than you are at the beginning or the end. It's only 50%, but that's enough given the hours choices that you'll actually work a lot more in the middle of life than you will at the beginning of the end. So one way I sometimes describe this is think of a family of doctors. So you've got the young doctor, the middle-aged doctor, and the older doctor, and the young doctor is still in medical school. The middle-aged doctor is working like crazy, and the older doctor is retired. And yet these three doctors live right next to each other in identical houses, and they drive identical cars, and they live exactly the same life. Well, how is this possible? It's because of the credit market, which is allowing the young doctor to borrow against future income, but the middle-aged doctor is working like crazy, and then the older doctor isn't working at all, but is living off the past income, so past investments. So this is perfectly smoothing. For this family of doctors is perfectly smoothing. But if you just took the Gini coefficient for those doctors, it's only the one guy that's actually earning a lot of labor income at that point. The older guy is earning kind of capital income and maybe some labor income. So I actually think this is a good ballpark for the Gini coefficients. Now on the quantitative easing, I've steadfastly stayed away from that issue, I guess, in this paper. But the point of the paper, I guess, is that if you want to do a version with a zero bound, we do have this earlier version with Kostas Zariadis, Artie Singh, Jacek Suda, and me. That's published in the Journal of Economic Dynamics and Control. That version has a zero lower bound and has some other features. And we do talk about that. There's really no currency in this model, so you kind of don't have this idea that they're going to households are going to switch to some other asset. So it's really probably not a good framework, just as I presented it here. It's not a good framework for identifying this issue. I would just say one other thing about this for there might be a few students out there that are interested in this. You can actually price out the entire yield curve all the way out to 30 years by quarter in this model, because there are savers who are middle-aged and young people that want to borrow all the way out to 30 years. So you could actually get the whole term structure, and then you could talk about operating on that term structure.
Jim, final questions. I think we've just got a few moments left before I hand over to Christopher Dow's daughter, Francesca, for a vote of thanks. Two questions are kind of linked in the same broad space anyway. Martin Wheel, former director of the Institute, former monetary policymaker in the UK, asked, how would inheritance affect this? And John Price, who's at one of the government departments, asked, what happens if life expectancy increases or is expected to increase? So these are both kind of added real life complexities, but in the same broad space of generational stuff shifting.
Yeah, of course, there is a rich and very great literature, I would say, on life cycle models stemming from, Diamond and Shell and many others who made their careers analyzing it, and certainly Barrow. I think on bequests, what you'd like to do is have, a warm globe bequest that would match the data. So I'm going to give a watch to my son, and then my son is going to give a watch to his son, and so on down the ages. And then the value of this watch is going to grow exactly at the rate of interest. And so you would observe bequests, but they wouldn't have any impact on the equilibrium. So that would be one way to do it. You've also got Bagwell and Bernheim from the late 80s who pointed out that with marriage and all kinds of other factors, you're actually mixing up. There isn't a straight line dynasty. That's getting mixed up over time. But I guess my view on this is that this model has so much promise to be able to talk about inequality in a very transparent way that you probably don't need to worry so much about bequests as it has been in the historic literature from the 70s and 80s. I'm sorry, the other question was about?
Inheritance and life expectancy.
Life expectancy, yeah, another great issue in the OLG literature. Yeah, it would impact things. There's no question about it. You might also say, what if I extend things to earlier in the life cycle? So I start keeping track of 16-year-olds instead of 23-year-olds or 20-year-olds, and that would make a difference too. So I think you have to balance those two effects about when you think people are actually entering the market, the labor market, and how long you actually think they'll be around, and how productive they'll be at all those points in the life cycle. But to me, what helped me a lot, I've worked a lot on life cycle models, was to try to abstract a little bit from those issues. We know mathematically that those things are going to matter, but by doing this very simple thing and having things peak right in the middle, that helps you in isolating, I think, what the big issues are from smaller issues.
Jim, thank you very, very much indeed. Thank you for your answers. Thank you for your lecture. And I must say, I think it's an important moment for us in the UK and London to see a seasoned senior monetary policymaker presenting research and engaging with some of the issues that have developed in recent years. I'm now going to hand over to Francesca Dow, Christopher Dow's daughter. Hi, Francesca. For a vote.
Hello, and
over to you, Francesca. I will disappear for a second.
thank you, Sir Paul. But as you said, Sir Paul, I think my father would have been concerned about the circumstances in which this debate is taking place, but absolutely fascinated to hear what you've got to say. So I'm not an economist, but I was also very interested, and that we have such thoughtful and brilliant people such as you to think about these matters, to help us find our way out of this pandemic. But my real job here is to say thank you on behalf of the Dow family. My 3 siblings are on this lecture as well as some of Christopher Dow's 12 grandchildren. But my job now is to hand you a medal, and I'm very sorry we can't give it to you in person, but it will come in a lovely box. Here it is. I don't know if you can see it. It says NIESR and Dow lecture, and on the back your name, and it will be finding its way to you in actual fact very soon. But meanwhile, this is a big thank you from me on behalf of the Dow family. Thank you.
Well, thanks so much, and thanks to the Dow family for supporting this important lecture. It's been an honor and a privilege to be able to participate, and I hope I've stimulated thinking on the important macro issues of the day, which is, I'm sure, what Christopher Dow would have hoped for.
Francesca, thank you very much. And to your siblings and children and nieces and nephews, I'm going to use words that are regularly used in the United States, but not so much in the UK. This lecture that the Institute hosts is in honor of your father, and it's to thank your father for his service. And Jim, thank you for yours, and thank God it's still going on. let you flourish, and let all the audience flourish. Thank you for joining us this evening. Bye-bye.
Bye.